Hello, this is Trent Chapman with New Future Realty, and today I want to share with you a little bit about foreclosure and short sale, and if your loan is a loan that has recourse options, meaning does the bank have the ability to come after you and sue you for the loss on a short sale or foreclosure. Now this is a very important thing to know when you're making the decision between doing a short sale, a foreclosure, or even a loan modification. For many people, if you're over leveraged $100,000 to $200,000 in your mortgage, a loan modification doesn't make sense, and you're looking at the option of either doing a short sale and wiping out that debt as long as you can reduce or eliminate the liability. Now that's really important to know, that you're working with somebody, if you're doing a short sale, that knows how to negotiate with the bank to release you of all liability. Not just a partial release of liability for the amount that they received at the short sale, but a full release of liability, meaning they cannot come after you for any loss. Now that's doable and something that's very common in California if you work with the right person who knows how to negotiate a proper settlement with your bank. Now the short sale and foreclosure, making sure that one's a better option than the other, all comes down to liability. Earlier in another video we talked about 1099 and the loss associated with a short sale or foreclosure, and how the bank can issue you a 1099 for that loss. Now on the other side, if the bank chooses not to issue a 1099 and they have the right to sue you, they could sue you for that same amount or that same loss. So here's how we have to determine whether a short sale or foreclosure is a better option. It really comes down to what type of loan do you have. Now in California, there's two types of loan that are primarily looked at as either recourse or non-recourse. Now if you buy a home and you do not cash out any money, you have the original loans that were used to acquire the property, that's considered a non-recourse loan. So that means if I have a first and a second with Bank of America and I never refinanced those loans, let's say it was originally with Countrywide and Countrywide sold the loan to Bank of America, but I never refinanced that home, that's still a non-recourse loan as long as I occupy the property. So it's, in California, law states that if it's owner-occupied, purchase money, the bank cannot sue you for the loss. Even if they do foreclose and lose hundreds of thousands of dollars, they do not have the right to sue you. Now, why is it better than to do a short sale in a case where it's purchase money and it's your primary residence? Well, if you live in the home and you never refinanced, never cashed out, then it's still a benefit to do a short sale, because oftentimes it allows you to stay in the home a couple months longer as we're negotiating with the bank to do the short sale. Whereas if you just let it foreclose, the natural course of a foreclosure in California is in between 7 months to a year, in which time the bank will foreclose. Typically with a short sale, they'll be able to stay in the home an extra 2 to 4 to 6 months longer as we're negotiating with the bank. So that's the one benefit that there is for those that are purchase money, primary residents, to look at as a short sale as an option versus just letting the home foreclose. Not to mention the benefits of reduced credit impact with a short sale versus a foreclosure, and the ability to buy again in the future sooner than if you have a foreclosure in your credit. Now looking at the loans that are not purchase money, let's say you bought a home, then you refinanced the home, but you never took any cash above and beyond the purchase price, it's still may be considered a recourse loan. Now here's how you can determine whether or not your loan is a recourse loan. California recently passed a law that went into effect January 1st, 2011. This law states that if you do a short sale on a property that has a first loan, that first loan has to release you of all liability. So if you have two loans, the second loan doesn't necessarily have to release you of liability, but the first does. So even if I had a refinanced property, or it's a second home or a rental property, if I do a short sale in California, that first lender must agree to release you of all liability as part of the short sale. That's a new law that went into effect. Now here's where it becomes tricky. Second lenders were not included in that law. So if a second lender agrees to do a short sale, the only time that they really have to release you of liability is in the case of a purchase money second loan. Or in other words, I bought a home with two loans and I refinanced those properties. That second loan in a short sale does have to release you of liability. Now here's where it gets tricky. If you're working with an agent that doesn't understand that, a bank can change those terms on a purchase money second loan and say, I'm sorry, but we will not do a short sale and release liability. And if you accept those terms, there's no law in California that says the second lender cannot adjust those terms. Now, there's yet to be seen any case law to substantiate whether or not a bank really can sue you in a second loan position if they do not release the liability on the short sale approval letter. Now, this may be confusing for a lot of people, but to make it more simple, you can always call me or email me, and I will give you a direct response to your specific situation and how it may or may not affect you. Now, of course, I'm not an attorney and I'm not a CPA, so any definitive CPA or legal questions you have, you want to ask a CPA or an attorney to make sure you're getting the answer for your specific situation. I will give you a general understanding of California law so that you can research it yourself and ask an attorney or CPA for their opinion based on what I've shared with you. Now, talking about second liens that are cash out, or it's a second home, or it's a rental property, you still can get a release of liability on those loans. For example, I had a client who had a $250,000 HELOC that he cashed out above and beyond the purchase price of the property in order to make some modifications to the home and also to use for some other debts that had to be paid off. This client said that I will not do a short sale unless it's a benefit over foreclosure. In other words, he would not do a short sale unless I could get a full release of liability on that second loan, because the second lender, per California law, has the right to seek a judgment or get a judgment against the homeowner by way of suing them in court, and that homeowner would have been liable for that $250,000 if the home were to foreclose. So in order to make this gentleman agree with the short sale, our job was to negotiate a settlement with the bank to agree to release him of all liability. Now in this case, it was a Wells Fargo first loan and a Chase loan that was in the second position. And we were able to negotiate with Chase Bank to release him of all liability by being able to give Chase Bank a little bit more money than was originally agreed upon between the first and second lender negotiations. Now, this is not something that's easy to do, but with the right negotiator and the right team who knows how to negotiate a proper settlement for you and on your behalf, it's important that you know you can still get a release of liability even if it was a cash out refinance on a second home, on a rental property. So in California, is it possible to get a full release of liability on both your first loan and your second loan? Yes, it is, with the proper team that's negotiating for you. Do most agents know how to do this? No, they don't, and unfortunately, only 1 out of every 5 short sales actually closes because most agents don't know how to negotiate with banks. So if you're looking at that as an option and it's seriously something you're considering, you want to talk with an agent who understands the recourse and association of a cash out refinance, a second home, a rental property, and how they can eliminate that or limit that liability that may exist in a short sale versus just letting the home foreclose and leaving that liability open-ended for 4 years. Because California does have a 4-year statute of limitations in which time a bank can sue a homeowner if they have a recourse loan after foreclosure.